In this video, we will review the class exercise from Wednesday, where we forecast our income statement and balance sheet and free cash flow using the method where we look at ratios and then drivers and then calculate our forecast. So the first thing we did was start on the income statement, but let's get a big picture view of this sheet. We have an income statement which is history off of, let's say, your 10K. So let's go ahead and designate that to be values, constants, by turning the font blue. And then we have a balance sheet, same thing, we'll turn that font blue to signify that those are constants. And then after we know the net income by forecasting those two sheets, we'll take that profit after tax or net income and then back out the accounting items to end up with free cash flow. And then we'll take the projection of that free cash flow and use our DCF template that we had in quiz 4 to calculate equity value per share. So let's start at the top with the income statement. And the first thing we're asked to do is look at sales growth on a year-over-year basis. So we can't start in 2014. We have to take 2015 over 2014 minus 1. You could also calculate that by saying 2015 minus 2014 divided by 2014, and you get the correct answer, but this is quicker and less error prone, so this is how I like to do it. And then our cost of goods sold as a percentage of sales, we could go up and take that extra data point. So happens that in this problem everything is constant through all of these years. So as I paste that formula here, then we see that cost of goods sold is about 50% of sales. Now the way I've calculated it is we've left that negative in there. We could be more purist if we wanted to truly see cost of goods sold as a percent of sales. But I think taking the negative out here and then trying to back it out in the forecast is not worth the time. So we're going to do it this way. I'm also going to copy the format, paste formats, so that those 2 years look the same. And then we need interest payments as a percent of average debt. So we know how much interest we paid. And as we discussed in class, in this model, a negative up here on the income statement reflects cash going out. So that interest payment divided by the average of our debt looks like this. And of course, our debt was the same in both years, so you might think we don't need to average it, but much wiser to do so because it won't always be the same in both years in every problem. And the reason we use the average debt is this number represents what the debt was at the end of 2014. This number represents what it was at the end of 2015. So taking the average of those two numbers gives us the most representative debt across the year, and the 32 applies to interest payments that were made across the year. And we find out that our average cost of debt is about 10%. Similarly, our average cost of, or our average interest earned on capital that year was about 3%. Depreciation as a percentage of assets at cost, we're just told how to do that. So again, we'll take the depreciation, divide by the average assets at cost. Every problem might not say to use assets at cost. You might think, I think it's more logical to use the net fixed assets because that's what remains to be depreciated. But there's an argument to be made for either one. We don't care about either argument really. We'll just do what the problem suggests in this case. And it says that our depreciation shown on the income statement is going to be about 10% of whatever our at-cost fixed assets are. And again, at-cost fixed assets are the cumulative amount of any investment we've made in capital assets. Moving on to the effective tax rate, simply the taxes that we paid divided by the profit on which we paid taxes. And again, because of our sign convention, it shows up as a negative, but the proper takeaway from this is that our effective tax rate is in fact a positive 40%. And our effective dividend payout ratio, or our dividend payout ratio period, is 70 over 174. We're paying about 40% of our profits out as dividends after tax. And our share count growth in this case is going to be 0, but let's go ahead and calculate it in case we update our history and find out that it's not 0. Then we learned a shortcut for this application. If we highlight that block of cells and hit Control R, we can fill in all those formulas across. Now we need to make a judgment call. What should we forecast our sales growth to be? Now in this problem, pretty obvious that 10% throughout history, it would be logical to continue to forecast that at 10%. But it doesn't have to be that way. The cost of goods sold, similarly, we'll put in a negative 50% and a negative 10. We'll just carry all these numbers down. Since history has been so consistent in this case, we'll use those consistent ratios as our drivers going forward. We'll highlight, Control R, and fill them across, and then they're filled in as values. Probably tempting to say equals the cell before it, but since these are highlighted in blue font as constants, we'd really like to put those in as constants in case we decide one year it's not going to be quite the same. Say it's only 5, it won't mess everything up. I'll undo that. Now as you work on your team project, you'll study the company and you may say, we expect history to continue for a few years but then change in either a positive or negative direction. And that's why we want these as values, so you can think logically, specifically about each one. Now if we know our sales are growing year over year at 10%, then we should be able to come up here and say the previous year times 1 plus 10% to get those sales. If we know that cost of goods sold as a percentage of sales is a negative 50, then we can just multiply sales times that negative 50. And in each one of these formulas, we'll just undo the math that we did over here. And so to calculate interest earned, we know interest paid. We know the amount we're paying times the average debt. Now in this case, we haven't filled in debt yet. We're going to write a formula that will work when we fill in this cell. Fortunately, it will work okay until we fill in that cell, but really until we get that cell right, we haven't completed this. So let's go ahead and take that and do a similar thing on the next couple. Where we take our effective interest rate times the average cash, which again, we only have one of, and the effective depreciation rate times the average. And since we used assets at cost to calculate the ratio, we must also use assets at cost to apply the driver to. And each time we do one of these, it's helpful to look and see if we're reasonably on trend. That would be a time to identify if we got a sign off or something like that. So profit before tax, when we look for a driver on that, we don't have one, but then we realize profit before tax is our sales minus all of these costs, or in that case plus. Let's say it's the algebraic sum of sales and costs and payments we made and payments we earned and depreciation that we took in accounting sense to give us profit before tax. So we can come over here, do an alt equal, and we have our profit before tax. We know that times this driver that represents our effective tax rate, even though it's got a negative sign, it gives us a number that's right on trend with what we've seen before. And profit after tax is simply the profit before tax plus the tax, if the tax is shown as negative. Dividends, very similar. We'll take the dividend payout ratio that says that 40% of our profit after tax is going to dividends, and see that we pay 100 out in dividends. Our retained earnings are the difference between that profit and tax. Add the negative dividends, and we know what our retained earnings are. And our share count, in this case, we calculated as last year's share count times 1 plus the share count growth. Even though it's 0%, we'll use the formula to calculate it. Then we should be able to copy these formulas across using the Control-R shortcut. And we see a lot of divide by zeros. It's only because we've got a lot of blanks in the balance sheet that we haven't filled out yet. Those should go away when we come back. And I will put formula text on here in case you'd like to check that formula. Now let's come to the balance sheet. Again, start in the upper left quadrant, look at our history, and then calculate the appropriate ratios on that history. So our current assets as a percent of sales, we'll divide by sales. I think I'm going to start on 2015 on this one. Current assets as a percent of sales. And since all these are going to be a percent of sales, I'm going to remember that sales is in C5, and I won't have to come up here and look again. So it looks like our current assets account is running about 15% of our sales. So as our company grows in terms of sales, our current assets should probably also grow. Our net fixed assets as a percent of sales, 77%, and our current liabilities as a percent of sales, 8%. We could even show an extra decimal place on that. We can copy that using the Control-R. And then come over here and continue those same drivers forward unless we read something in our equity research that tells us to do otherwise. Control-R. Now to come up here and calculate cash, we're told in this problem to use cash and marketable securities as a plug. That means that we need to balance this balance sheet using that. I'll come back to that in a moment. Let's do current assets right now. We know that the current assets are 15% of whatever we calculated up here in sales. And we'll use G5 several times. I believe net fixed assets as a percent of sales is that number times G5. And current liabilities is that number times G5. Let's see what order we should do these in. Probably doesn't matter, but our fixed assets at cost. So this line represents the cumulative of all the investments we've ever made. This line represents the cumulative of all the depreciation we've ever taken. And this line represents the difference between the two. Now we don't have anything in this problem above telling us about what kind of investments we've made this year, but we do know how much depreciation we've taken this year. So since this is the accumulated depreciation, to continue to grow that depreciation, we take whatever it had accumulated to before, and we want to add the depreciation from our income statement on row 9. And we see it on trend with the recent accumulated depreciation. So if we know what the net is, and we know what the cumulative depreciation is, we must know what the cumulative capital investment in fixed assets is. And often that's called fixed assets at cost. So we know it must be this number minus this number. And that puts us on trend with these, so that's a good check as well. Since this is on trend, this is on trend, it makes sense that that would be on trend. And I'm speaking very, very generically about what trend is here. Just seems to be going up and to the right. Now let's talk about debt. I think we're told over here to hold debt flat. Need to be more specific about that in writing these problems. But in order to hold the debt flat, we could come down here and say debt growth year over year %. And we could calculate that that had been 0%. Paste that format. Use Control R. Say 0 going forward. Control R. Do this the long way. But in this problem, it's for debt, stock, and for debt and stock anyway. We weren't really told to calculate that ratio, so for stock, we'll just take a shortcut and take the cell to the left. Now, accumulated retained earnings, we do know what they had accumulated to before. So if we add on the retained earnings from our income statement, we'll get a number there. Now we have numbers for total liabilities and equity, so we can alt equal and just sum that up. And we know that the sum of total assets is going to be this cash number that we're going to get from the plug, plus the current assets, plus the net fixed assets. But we see that our total assets don't balance our total liabilities and equities. In order to bring that into balance, we need to come up here and plug the cash and marketable securities. And so the way we do that, let me flip over to PowerPoint here for a second. If we imagine our balance sheet as a left side with the total assets and a right side with the total liabilities and equity, then we realize that all the pieces over here must balance to all the pieces over here. And so if we know all these numbers except cash, then we can take this side, subtract all these other items that are not cash, and say cash is equal to total liabilities and equities minus everything that's an asset that's not cash. And so let's do that here. Cash is equal to total liabilities and equities minus everything that's an asset but not cash, which would be current assets, and not at cost or accumulated depreciation, because those are netted to this number and doesn't go into total assets. But in terms of our balance over here, we're taking total liabilities and equities, whatever is in there, subtracting off all the assets that are not cash, and that's how we came up with this formula right here. Total liabilities and equities minus the assets that are not cash. Extremely repetitive, but an extremely important concept. By doing so, we've brought our balance sheet into balance. We can highlight all these cells and hit Control R. Now when we go up and look at the income statement, we see that all of those that were previously divided by 0 have now been corrected because they have numbers to use. And we have balanced, or we've integrated our income statement and our balance sheet. So there were places where each was looking at the other. There were places here where our interest payments on debt depended on something on the balance sheet, and there were places on the balance sheet that depended on something on the income statement. And that's why we say that these are integrated in a circular way. The next step is to take the free cash flow, to get the free cash flow by beginning with the profit after tax. We don't begin with retained earnings because that's just taking some of the earnings and giving it to the shareholders. We could start with this and back this off, but that would get us to this number anyway. So let's start with a profit after tax and think about what we might need to back off. Depreciation is something that we took out to reflect investments that we had made in the past, but we want to add that back in since it's not part of our free cash flow. Then we want to subtract our increase in current assets So we'll subtract what our current assets are now minus what they were before, which means the increase. And by subtracting the increase, we're taking off 10. To add back the increase in current liabilities, we will add the difference. And then to subtract the fixed assets at cost, this is representing money that we spent on capital investments. It will later be reflected in depreciation, but to get to free cash flow, we needed to reflect it now. And then finally, we will add back our interest on the debt after tax. So we need to get our interest that we paid on debt times, and we would say 1 minus the tax rate to get after tax. But remember the shortcut we made to make this negative, we're going to say plus the minus 40. If that actually said 40% that was our tax rate, then we'd say minus that tax rate. We're looking for a number here less than 1, and so we need to add a negative 40% to get to it. I'll put some extra parentheses on there. We don't need that. Wouldn't hurt, but don't need it. To add back the after-tax interest on debt, let's first, since we know that interest on debt is going to be negative and we want to add it back, put a negative sign there, get the interest that we paid on debt. Be sure to grab it off the income statement and don't stop short and grab the ratio that begins with the same words. Interest payments on debt, and now we need the after-tax portion of that. So it would normally be 1 minus the tax rate. We have a negative tax rate because of our sign convention here. So I can say minus a negative, or I could say plus. Finally, we want to subtract the after-tax interest on cash and marketable securities. So almost exactly the same formula. We want to subtract a positive number times 1 minus the tax rate, so we'll say plus this negative 40%. And then if we add all those up, we get our free cash flow of 134. And these are actually formulas that we can copy all the way across. The Control R. And now we have a free cash flow stream that we can use to calculate our terminal value and so forth. I'll run through that quickly. Terminal value is equal to that final cash flow in the perpetual growth method times 1 plus the rate at which we think it will grow after that, divided by WACC minus the rate it will continue to grow after that. That would work out to a multiple of about 7 times, which isn't quite as big as the exit multiple we're going to assume over here on the other method. And then the present value of the cash flows themselves, we can use NPV discounted at the WACC of the future cash flows, and we can put all these future cash flows in the NPV. We don't have any time zero cash flow. That 164 is history. And then we need to bump that up to mid-year discounting, like so. Present value of the terminal value, just take that future value, divide by 1 plus the WACC to some exponent, and the exponent is going to be 1, 2, 3, 4, 5 minus a half for the mid-year discounting. So we'll say this minus the half should give us the right number. And then the enterprise value is the cash flows plus the terminal value on a present value basis. We'll add in the cash at the end of this current year of 180 and subtract out the debt of 320. For an equity value of 1208. And if we divide that by the share count, we get 1209 per share. Let's see how that compares to the multiples method. We've already calculated our terminal value with the multiples method and found out the corresponding implied long-term growth rate. Now we need to take the PV of the cash flows again. Same as before. In fact, we could just use that number again. Hasn't changed. But the PV of the terminal value this time is the new terminal value divided by 1 plus the WACC to that same exponent. We can copy some of these formulas like the sums and the division, and the others we can just say use the same value for cash, debt, and shares that we had before. And we see that our answer here is reasonably close to our answer using the other method. Now I'll go ahead and add the formula text in case you want to check formulas. If you look closely, you're going to see that the answer we got in class is very slightly different than the answer I got in this video. And the reason is, I believe in class I copied and pasted as values the sales growth and one of the other growth methods. And in this video, I just typed in a 10%. The answers are off in about the 4th decimal place. Let's compare this 10% to this 10%, 10.011%. Describes any small difference between these two approaches. Again, that's because in class I copied this and pasted it as a value, and in the video I typed in 10%. Close enough for our purposes. Better than we can forecast sales growth in real life, for sure. I hope you found this video helpful and a great study aid for the upcoming exam.